on this movement in the bond markets this week, what would be the biggest implications on EMs? I mean, should we still be talking, what, EMs for now? EM currencies for now?
I mean, I think it's pretty simple. It's still a pretty negative environment for EM, and we think it's going to continue for a while. I mean, the first thing I'd say is look at the situation. You've got rising US bond yields, stronger dollar, and signs that EM growth is starting to roll over and slow down. That's a pretty ugly environment for EM. And I think the current account deficit currencies are the ones that are going to continue to be under stress.
So how do you expect central banks in Asia to respond? Is it going to be more of a lockstep with what the Fed does? If we're saying and forecasting one more December, maybe possibly 2 or 3 next year, is it going to be a move in tandem, or is it going to be a little bit more varied?
A lot more varied, we think, actually, Yvonne. So for the current account deficit countries, India, Indonesia, Philippines, even among those, we see more variation. We think India is not going to be raising rates much more, if at all. On the other hand, Indonesia, we expect at least one more hike in December. Philippines, because it's got an inflation problem as well, we expect at least 100 basis points of further rate hikes in the next 6 months. But then if you look at the current account surplus countries, predominantly Northeast Asia, their currencies have not been under that much pressure. In fact, on a trade-weighted basis, they're probably appreciating given other EMs are weakening so much. And the growth outlook is deteriorating. So I think for these countries, the market is expecting some like Korea, Taiwan, maybe Thailand to raise rates. The risk is that those rate hikes or normalizations could potentially be delayed.
Right. And Rob, the title of your report is, you're saying here, to your earlier point that on a trade-weighted basis, some of these currencies might be appreciating, is that current account surplus aren't always good.
Yeah, that's right. So I think, there's a lot of focus right now on current account deficit countries. And if you look at it from, what drives current accounts from a savings investment perspective, surpluses countries, it can be because of weak domestic demand and weak investment, which doesn't bode good for kind of longer term growth. And I think some of the Northeast Asian countries are actually in that camp. So they're insulated short term, but longer term the prospects aren't that good. But then, interestingly, some of these current account deficit countries, I would point out particularly Philippines and Indonesia, their deficits because investment has been growing quite strong. And it looks like it's going into infrastructure and manufacturing, the right spots. And so that actually bodes well for potential growth in the longer run. The key is to kind of not get caught up into deficit and then big currency depreciation and then this negative spiral. And so policy has to be very clever to get around that. Right. But the prospects for some of these deficit countries are actually good in the longer term, and it's important to remember that.
Rob, just very quickly, since you mentioned it already, Philippine inflation was out, right? The deficit is a function of how strong the economy is based on what you're saying. Is it overheating? Very quickly.
Yes, I would say the Philippines is the only country in Asia actually overheating. I'll give you one statistic. GDP growth in Q2, domestic demand contributed more than 10 percentage points to growth. Very strong.